Alright, hello guys, and glad to have you on board again today. That's another one I expected to release way longer down the line, but still turns out right now is an appropriate time to release that one. So we're gonna have to talk about the derivative markets, and the reason why I think this is where the biggest hidden danger sits, how long, or for how long this thing has been sitting in the background, piling itself into danger zones, and most importantly, why do I still believe that there is growth ahead, and that, well, even if everyone thinks that we're nearing the end and the big collapse is going to be there, I think that the data that I'm going to show you today suggests quite the opposite. It might come along the way within the next few years, but the risks we take on the financial system doesn't necessarily mean a collapse is going nearby. There is still some room to leverage the economy, and in that perspective, we haven't even started yet. So this is what we're going to be talking about. So first of all, it's going to be complicated, so I definitely cannot explain everything about the derivative market in just a vulgarizing 20 to 30 minute video. So of course, if these topics just scratches your head, do your own research and dig deeper into this. What I'll do today is to pick the best possible data I could get out of it, because this is definitely one area of shadows and lies or whatever. It's difficult to get the data to be verified and so on. So I thought, rather than going for some scary shit all along the perma-bearish guys or whatever, I decided to go for the top quality BIS data. So BIS is the Bureau for International Settlement. So this is basically kind of the central bank of central bankers. So they are gathering the data and they give us everything about the data set. So once again, I like that. That means the data might be biased in a little while, but still at least it has been professionally compiled. So this is at least best of what I could find out there. So the data is split into two sets. There is exchanges traded derivatives, basically anything that is in the exchanges pool, which is basically they're getting and accumulating their clients' positions, and this is where we're going to see their clients' positions. And the OTC derivative is, of course, where we get the biggest amounts, and we're going to see it through the data to confirm it. Of course, this is everything that happens in the interbanking system. So this is where, of course, there is no regulation, lots of shadow things, and this is where confidence is key. I've always made it clear the entire system lies on confidence. So if there is ever lack of confidence between two big parties, then this rapidly spreads out to the entire system. So it's really everything that there is, and there has been on the 2008 crisis. So we'll see all about that. So, okay, so we need to understand both of these things. Okay, so this is in-house volume for exchange data, and this is in between houses OTC derivative desk. Okay, so in that perspective, let's have a look at this. So if we look at the derivative data in the exchanges, I think this one will be the most suitable one to look at. Okay, so what we care about in this table is this level. Okay, so this is in the interest rate markets and the foreign exchange market. We see the relative data is what we care about. Though the first big set of warnings that I'm going to release out there is that what we're looking at may sound like a scary, shitty number, like this $1 billion. Okay, so this is $79 trillion of notional exposition to these inbound, okay, or inside the exchanged demands. So the thing is that, of course, if we just look at that data, raw data, we would say, man, $79 trillion. How much did the Fed buy during the COVID pandemic? Wasn't that like just 7 trillion? So this thing has a notional value that is 12 times bigger than what the Fed actually did, and just look at what the Fed did and the amounts effect it had on the economy. So of course, these numbers, put it out of context, makes no sense. Okay, so understand once again that this is the accounting way of doing things. If you take the notional principal value of these assets, they have tremendous value because we're talking about interest rate assets. So these have absolutely gorgeously enormous kind of notional value because it's debt related products. But if you have to understand it in an accounting way, okay, remember that these are basically two-sided tables with expenses and revenues on the other hand, or not revenues, okay, but you got it, okay? So it is basically that if you take the asset on one end and the cover trade, which is basically an option or a derivative market to cover hedge against whatever risk that is, beta, delta, gamma, theta, vega. There are like just crazily endless types of risks for a broker to cover against. And in that perspective, it's an accounting step. So basically, the notional value that you're putting in here is in an accounting table. Though in that perspective, it's kind of double counting everything, because you have the asset and you're covering against it. So in that perspective, the notional value in here doesn't mean that on the balance sheet of these things are like a liability. It's not, okay? It's just basically, it's equally distributed among the two sides of that table. So the notional value isn't really that much of a big deal, okay? But it really is counting a lot. So anyway, we're not going to take the raw value. I just wanted to take about that notional principle. There are other data that are generally less fancier than that, but still the numbers are staggeringly great as well, in which we account for all the not net and balances stuff, which means there are some cover contracts that are being used without having the principal on the other hand. So in that perspective, this is a liability. That means if the contract defaults, then there's nothing to cover for it on the balance sheet. So that would be the net growth, the growth value of these assets. So of course these numbers would be severely lower than that, and we don't have these numbers in here. But just to set things real straight, okay, the numbers that you see in here are the numbers the perma bears are generally showing to scare you the fuck out of here. They will sell, I mean, this is an enormous level of derivative exposure. So yes, of course, but this is balanced with the principal on the other hand on the accounting firm, on the accounting level. So not that big of a deal as a raw number, okay, but definitely still absolutely staggering numbers. Absolutely staggering, okay? But these amounts are not paid for, okay? You have to understand. They're not paid for. They're balanced out on the accounting stuff. Okay, so that's for one hand. That's the in-house thing. And as we can see, it's far more into the interest rate kind of derivative markets rather than the forex market. And we'll see that that's definitely the thing that I care a lot about. Then if we have a look at the OTC derivative, because what we look at is the context, okay, how these numbers relate one to another in terms of proportionality. The numbers themselves, like I said, don't really make that big of a deal. They're just so big that they make no sense. Okay, then if we're going to have a look at the global OTC market, we're going to divide them into section 5.1 and 5.2, and these are the twos we're going to have a look at. So once again, we pay attention to the numbers. Oh boy, OTC desks, $600 trillion. So the numbers in here, absolutely. Remember what we've said before, okay? The numbers before, they're 10 times bigger on the OTC desks. So there are 10 times more money being being exposed in the interbanking system than there is in-house volume on the exchanges themselves. And remember that everything that happens OTC is unregulated, not oversighted. It's just upon declaration. And well, this is where the big problem stands. Okay, so what we could see out of this is, of course, lots of this comes from the US dollar. Okay, so very much it's the same old game. US dollar is the reserve currency. Lots of transactions are settled in dollars, but still, when it comes to derivative speculation, it is definitely way more dollar stamped than people would like it to be. Okay, and when we see this massive things, this is basically most centered into interest rate contracts, okay, and these are credit swaps most generally, okay. So this is what we wanted to have a look at into this section. The equity link kind of exposition is still $7 trillion. Once again, the question is, do we really have $7 trillion of speculation to pull aside? This is quite of a good question. But still, in here, we can see that this is largely in the debt sector that we have these things. There is quite of a reasonable and rising, and we'll see that. This is very, very important. As you can see, this one is kind of stable or decreasing slowly but steadily on just the course of a few semesters. This one is severely increasing, and it's been going on for long, and it's going even bigger. So it's getting started with the FX, the forex markets, derivative exposition, and I've always made it clear that's one of the things that I scare the most about within the next few years. I warned you about these things in early 2022, that we're going to get a value crisis, but most importantly, we're going to get a currency war. This is no longer going to be the good old games in which central bankers accord themselves to do this or that. It's going to be an absolute battle out there, and currencies will be the weapons. So this is what I've always pleaded for. Now you have the numbers. you have the numbers supporting this. So this is still what I wanted to point out, okay? Absolutely outrageous levels of speculation. Like, this is really derivative markets. 600 trillion. This is, oh boy, absolutely outrageous. And these are the numbers that are declared. Once again, everything in here is shadowy and the lines are blurry, and we don't really know anything about that. It's just upon declaration. Numbers may be bigger. Some perma-bearish guys estimate these things to be 1.5 quadrillion, like 3 times that. So, like we said, these are notional values. We don't know the exact growth related stuff on how many of these contracts are covered in an accounting legal way. So this is really, really hard and blurry stuff. The numbers are staggering, but once again, what matters to me is the dynamic. Where is the money going? But most importantly, what we've seen before is what I care a lot about is how it is playing over time in context, okay? So this is where we're going to spend most of our time at that current stage, okay? So what we see out here is the different compositions of the overall debt, okay? So the overall derivative exposition. So as you can see, it's pretty much been flat since 2008, and we're looking at notional amounts, okay? So remember that in the meantime, if we were having a look at the money supply, M1, this thing has basically gone nuts, okay? So this is like the relative sides, the relative exposition of derivative markets related to the actual explosion, okay, of US dollar value, of US dollar in circulation, means that the net exposition to derivative markets has actually gone low, okay? And you can see that there is demand for derivatives that goes higher, and then it goes lower, and then it goes higher and lower, okay? So where are we in the derivative exposition kind of cycle? Because there's definitely all of it, and I'll explain everything relating to economic cycle and speculative cycles, because this is really all about that. As we can see, when we build speculative bubbles, okay, like 2008, it's been definitely all about that. It was all about credits, and well, at some point, you know everything about that story. You might have seen The Big Short and some things. So the insiders who had access to the data knew the thing like 2 years before it collapsed. By 2006, they knew that something was going wrong, that some very cheap credit was offered to people who wouldn't be able to service that debt, so that basically we were going to get default at some point down the line. But for some reasons, the market was just boasting for these things and bundling those credits and creating default swap, like kind of insurance against those default that were definitely not accounted for properly, because the notes that we're getting were just triple A's, when someone on the inside who were looking at the raw data would immediately say that probably a third of these debt will never be serviced and that these guys will bankrupt at just an minimum U-turn. Like, if the economy just slows down a bit, these guys will default immediately. And those CDS who were sold at very cheap prices, like a cheap insurance because no one needs that insurance layer, well, all of these CDS will probably be out liquid. And in that perspective, that's the bet that's been made on the Big Short, by the way. So the lesson to take out of it is that the guy knew 2 years ahead. And the market decided to leverage that bet against him, putting him in a very dangerous position by leveraging the exposition on the derivative market, by basically bundling these credit swaps, making shitty CDOs or whatever with that, absolutely complex risk limitation kind of systems, definitely bundling the risk in complex situations so that people don't really look below the surface. So this is really what happened that caused the collapse in 2008. And of course, as we've seen, the mark-to-market accounting has been just like fueling the fire by adding more gasoline to it. So this is really all about that. There was both an accounting problem and a derivatives overexposition to the market. It was really that insiders knew the problem, but they decided to hide it in complex derivative schemes. So this is kind of a cycle, okay? We build up something, there is a problem that gets visible enough, and then we over-speculate on this because there's so much money to make out of these things. And though we create complex derivative schemes to over-leverage the market until, of course, sooner or later, truth comes in, and as the tiniest of economic slowdown shows up, the problem starts to be dig deeper into, and in that perspective, we figure out that those who've been selling some complex shit schemes were actually selling shit to people. And of course, when we start looking deeper into the problems, we figure out that there is a systematic event, and this is where mass liquidation kind of occurs. So this is the speculative cycle, okay? So there is the economic cycle running its own thing, okay? And it's unpredictable to know what the economy is doing. We've made an entire video about that. The model I use is the one that is based on both Ray Dalio's, like macro cycles with reserve currencies and battling for these dominance on the world, and there is sub-economic cycle in which I generally use like more of an Armstrong-based stuff, which you have, which I think I've made a video about. So this is the thing, and there is speculative cycle, which means on top of this real economic cycle, asset prices can totally derive from their actual economic value, and these things just because of speculation being added on top of it. And this is why I'm getting really, really, really interested about now, and I really thought that this was the missing piece of the video set that I've made previously. If you don't have this one, you won't understand and see the market the way I do. So it's really that way, okay? Markets are not about economics only, but this plays a major role. Markets are not about macro cycles either, but they play a major role, okay? And markets are not just about speculation, but still it plays a major role as well. So it's kind of a broad combination of all these messes to create a dynamic system that makes it not fully random, because it's not. These things follow cycle, but these cycles can either be correlated or they play and rise in the same time or not, and they create prices movements. So this is where this is the way I see the markets personally. These are the three major pillars of markets: speculation, economic cycle, and macro factors. Because macro factors are something you can't fight against. When one currency is put into the downside because of overuse of reserve currency, it can only go down, and you can't do anything about it. You can push it, you can try to push the can down the road, but anyway, it's inevitable. So yeah, the dollar is going to lose its currency status. It's inevitable. It's just a matter of time. We can slow things down, but it's going to happen. The second thing is that, well, the economic cycle means that we were definitely overheating the US economy before the COVID showed up. Trump definitely threw gasoline on the fire. But still, I mean, the economy has to suffer the withdrawal effect. Then we had that very violent and unpredictable withdrawal effect with the COVID, which definitely, instead of just creating a recession, has created massive supply chain disruptions. And in that perspective, the problems we were trying to solve were actually being destroyed due to another factor that created even deeper problems. So we're trying to figure a solution to this by just flooding the system with money. And now we're going to have to pay the problems of that cheap money by having interest rates rising. And as we've seen, we cannot go way too big in interest rates rising, because all of these derivative markets, they have massive exposition to this. So if we don't account for this as a risk, you have to understand that if we play too much of the economic side of the equation, interest rates have to rise, but if we rise them too quick, then it's going to trigger the speculative bubble. Because there's definitely hell a lot of speculation, and these levels, even though on a relative M1 basis, they have kind of going down, okay? There's still absolutely tremendous levels of exposition in the market for these things. Remember that this, in a notional value, if just 0.1% or 0.01% of this thing is unserviceable, meaning that it defaults because it was sheetly bundled or whatever, in that perspective, we're fucked. Look at the numbers. This is absolutely not possible. Okay, it isn't possible. Back then, credit derivatives back in the 2008 created the crisis by just these levels. Boy, look at what happens with interest rates. If just a portion of it ends up defaulting, there's no way out of this. There's no way out of this. So this can't happen. The Fed is locked in. They cannot touch too much of interest rates, otherwise it collapses. We've seen that most of this debt is serviced in $1 as well. So either we go into massive deflationary problems, because there's going to be hell a lot of a speculative collapse on top of economic collapse. This is like 1929 in steroids. So no one wants that, and I think it's less likely going to happen. But still, I think that there is a hidden battle into this chart. It's to look at the only thing that is actually rising. It's foreign exchange exposition to this market. I think that we're getting into slowly but steadily leveraging and making more complex bets on the OTC derivative things due to forex. And like I said, this is one of the signs that led me to orchestrate my personal plan on the macro side, which is I think that we're headed in a currency war, and that economies had a different relationship with debt, and they're going to try figuring out different ways out of it because there's way too much speculative leverage. So we cannot break the system. If we break it, the consequences will be absolutely disastrous. So we're going to try finding our way out of here. And of course, different economies will try figuring out different solutions because they have different population and they have different way to use credit. So there will be different way to solve this problem. But it mostly, I think, going to be figured out by leveraging the foreign exchange in that perspective. So I'm really carefully looking at this as a factor to leverage in the next speculative cycle. And I think it's going to be more and more leveraged as capital flow will go from this currency to another and so on. And I think as well, we're going to start leveraging interest rates as well, because lots of people were going to have to cover their trades first, to cover their exposition to rising interest rates quickly on some areas of the world and less faster on some others. So they're going to have to either arbitrage against currencies, but they're also going to have to arbitrage against rates. And this is the thing about the credit, the speculative cycle. It always follows the same thing. These are things that you might have heard from me before. Like the number one risk is alpha. This is basically like value shifting. You bet on the fact that one asset's going to go from area A to area B. This is basically trend trading. Okay, this is what I teach you in with my strategy, how to gather alpha from assets. Okay, so this is the purest type of investment because, well, it's not so complicated. It may look like it is when I try to teach you trading. It might look overcomplicated, but it's not. Okay, it's definitely doable by normal human beings. So you can learn how to gather alpha. It's not that complicated. It takes a couple of years to really fully grasp everything about it. Then there is, on top of alpha, there is beta risk management, which is basically you take two correlated assets that moves together, and then you're going to look for spreads in which one will move faster than the other. Okay, specifically in the trend's direction. One moves faster to the upside than the second one. And you're going to arbitrage them by basically buying asset number one. Okay, so they're both going from area A to area B, but you don't want to speculate on the alpha. You just want to speculate on the deeper side of risk taking. So you're going to basically buy asset one by selling asset number two. Okay, you're going to sell the one that moves the slowest and buy that with the one that goes the fastest. So you do this through options or futures, but anyway, it's going to be derivative markets expositions. Okay, you're going to use derivative markets to gather beta trading. It can be done through principles exposition, but yeah, nowadays it's mostly shifted in derivatives. Then there is, on top of beta, there is delta. Delta is basically that these assets have respective volatility, meaning that if they're correlated and moving both in the to the upside, well, that means one has a bigger volatility than the others, which means we can now, instead of just betting the fact that this one's going to rise quickly than this one, we can just bet on the fact that this one will have bigger volatility than this one. So we bet on the asset one delta against assets two delta, okay, which means we're going to take fully derivative exposition in here. That means buying one pot, buying one call, buying one put, and buying one call on both of these assets to delta arbitrage the volatility. Okay, and then there is gamma risk taking, which is basically even worse than that because it's adding the delta t in the exposition. That means basically you're also gambling on time. That means you're gambling on volatility and time as prices of as options reach near their expiration, when there's going to be a temporal factor that's going to increase how do we price that option. So some people are going to start gambling on this. So they're gambling on time over expiration and delta of rate. This is basically a delta is the rate of change. Okay, so basically they're gambling on the rate of change of volatility as we approach expirations. So as you can see, it gets quicker, it gets trickier and trickier to navigate these risks as we go deeper down the risk-taking curve. Okay, and on top of gamma exposition, you also have other stuff. Okay, there's theta and vega kind of risk limitations. So in that perspective, you have to understand that as we go further down the risk curve, okay, that means we're getting more and more mature in the speculative cycle, okay? So right now, the speculative cycle has gone way off alpha. There is no alpha anymore, as you can see. We're gone way off beta already. I think right now we're in the delta to gamma spread, which means we're advanced in the cycle. And this is the moment in which, if you understand the thing, you would understand that this requires no derivative exposition. You just buy the underlying assets, period. Okay, so this is pure growth. This requires, well, at least a bit of it. Okay, so it takes a bit of, it's not mandatory, okay? It can be done or cannot be done, okay? You decide if you want to do it with margin, in which you're going to go to derivative, or you can just borrow one asset to buy the other one. This is, in that perspective, not derivative exposition. This one can only be done through derivative things, and it takes 4 contracts to make that deal, okay? So the more you delta arbitrage a market, the 4 buckets is the minimum options you need. Okay, remember that these things balance out in the equation of accounting. Okay, remember that when you have 4 derivative markets, you're going to get 1 put, okay, which is going to be balanced with 1 put on the other asset, and you got 1 call, which is going to be balanced by 1 call on the other hand. Okay, so these things balance out. So this equals in 0 net exposition. There's a slight difference, of course, because this is where the trade is settled. So this is not net 0, but the growth return on exposition to this market isn't going to be that big, okay? It depends on how much risk is taken on that trade. But this still means that the notional value of those 4 options will rise up this chart, okay? So this is how you understand that the further down the line we go on a speculative cycle, the more we require use of these things, because this one, when we go gamma trading, it requires 8 brackets. So as you can see, we rise pretty quickly. And you guys, okay, now I hope that you guys understand these things. These are absolutely crucial to understand. Oh, sorry. Okay, sorry, where were we? Yeah, in here. So the thing is that as you get deeper and deeper into the risk management curve, this is basically because the market makers, though the Otc derivative notional value comes from the demand that there is on the inbound side of the equation that we've seen previously. So what I mean by that is the thing that when traders, be it retail, institutions, funds, or whatever, what they're basically doing is that when they're starting to risk take on delta trades, the broker has the gamma hedge, which means the broker itself on the Otc desk is going to require twice the amount of the risk that is taken by the traders on their end. So when these guys start piling up into the risk curve, the broker has to be 1 step ahead. No, it's more complicated than that. I'm just scratching the surface. But you have to understand it. As the traders takes more risks, the brokers has to take even more exposition to derivative markets. And that's what creates these parabolic scheming things. So this is the pile-up thing in which the general side of the market, the exchange-traded derivative side of the equation, is rising the type of demand for derivative constructs as they're taking deeper and more complex risks to speculate on the market, generally because they lack of visibility. So they're taking more complex bets to avoid being delta, to avoid being just alpha exposed to the market, okay? So they still want to make money out of more uncertain markets, so they're rising up the risk-taking curve, forcing the brokers to do 1 step more than that. As traders delta arbitrage, the broker has to gamma hedge against that risk. So this is complex, but like I said, just scratching the surface and explaining the mechanics. Oops, sorry, wrong button. So now that you know this, you know everything there is to know about these things, okay? The speculative cycle comes from one side of demand over the complex risk curve. As people fueled out all the alpha trades, they rise up to beta arbitraging the markets. When the beta is over, they're starting to go delta hedging. And in that perspective, as they delta hedge, they force the market makers to go gamma risk managing their portfolios and their exposition. And they do this on the Otc derivative things. The other metrics that had to be assessed is that the amounts that is being exposed are like 10 times. The amount that we have on the broadly traded assets is 10 times bigger when it comes to OTC desk trading, when the interbanking system has to hedge that risk and spread it all over the board, because basically they're going to ask other financial institutions to bring up this or that speculative asset. So this is really how complex that is. But you have to understand that the relationship is that when there is one side of the demand, it comes hedged on the higher side of the equation when the broker has to hedge against the highest set of risk. So when people are just alpha trading, it's easy. The broker just have to beta hedge. When the broker, when the clients are beta hedging, when the broker has to delta hedge, they have to arbitrage volatility. And when the traders start to delta fucking hedge, to delta fucking trade, well, the broker has to gamma hedge, which means the broker has to hedge against expiration times. And in that perspective, if the fucking trader starts to gamma trade, well, then the broker has to vega hedge. And this is really how you understand, because the demand for derivative products gets squared up each and every cycle up. So, okay, so it goes from 2 to 4, from 4 to 8, and from 8 to 16. And this is really how it creates this thing. The further down the slope we try to go, the more parabolic the demand for derivative is getting. So this is the reason why I don't think we're on the verge to a collapse, because otherwise I would already see the over-leverage in these derivative markets, and I don't see them. So I think we're still out at least a couple of years from the massive collapse that some people are selling to us. Because first of all, I don't see the speculation. There are definitely macro factors pushing prices to the downside. There are definitely economical cycle pressure with these supply chain things. But there's one side of the equation that can still be there to fuel market demand by pure raw speculation, and this one you don't want to miss. At least now you know everything about it. It's complicated, but now you have the full cycle of what really is all at play to move prices. So if you make the gamble that the economy is going to collapse because of the macro and economical factor combines, I would understand that. I'm hedging against that risk, but I also would like to let you know that on the speculative end of the spectrum, there is way more room to grow. So pay attention to this. If the speculators decide to go on more deeper and complex risky scheme structures, well, we have at least a couple of years to go by just speculative guessing on the market, by taking deeper sets of risks. And that means those who will try to catch up on the simple risk by just alpha trading, well, it's not going to be easy, okay? So understand it. We're going to get into more tricky markets to navigate, in which, well, there's still some money to make if you're good enough to speculate correctly. This is the reason why I've always made it clear. I think there's still some money to make in the market. Just throwing it out the window, just like there are too many problems, it's all going to collapse. I think it's a too easy of an answer. There are way more ways we can pull these markets into dangerous corners. And I think as we have the opportunity to do it, well, the market very likely will do it. So I'm not in the bear side now. I think we have one another thing to work around, and that's rising speculation through derivative markets. We are already in a derivative bubble that has never deflated from the 2008 level. We deflated in a relative basis to M1, okay? But I think, yes, we're on the verge to start rippling again. As we have no more M1 fuel to go higher in valuation, as, well, credit is going to be reduced, well, let me tell you, I think we have another thing to pull before the end. And we haven't even started yet. So pay attention to this. That was the last pillar to cover in order to understand at least the basics of what moves prices in the market on longer cycles. Bye, guys.